The popular conception of a commercial bank is a heavy steel vault, a static, secure repository where deposited wages sit idly, waiting for the customer to return and claim them. The mechanical reality is entirely different. Modern commercial banks do not hoard wealth. They actively expand the broad money supply out of thin air by issuing credit against a strict fraction of liquid reserves. This split-screen model illustrates the dual nature of our financial system. On the left, a central bank money, the fixed block of physical currency and base reserves. On the right is commercial bank money, the sight deposits and credit created by the banks themselves. This secondary supply massively expands as banks loan out a multiple of their underlying reserves. The engine driving this expansion is a mechanism called maturity transformation. This is the operational practice of borrowing short-term, taking in customer demand deposits that can be withdrawn at any second, and using them to lend long-term, locking that capital into 30-year mortgages and corporate debt. While maturity transformation functions as the primary catalyst for global economic expansion, it hard-codes a structural vulnerability into the system. The institution is permanently exposed to systemic liquidity shocks. Managing this inherent vulnerability falls to a discipline known as asset liability management, or ALM. It is the core operational mandate of any commercial bank. The offensive objective of ALM is clear: generate the maximum possible yield for shareholders. This requires optimizing two metrics: net interest margin, the spread between interest earned and interest paid out, and return on equity, a measure of how efficiently the bank turns shareholder capital into profit. But that offensive strategy is constrained by a rigid regulatory boundary. This equation represents the Basel III Liquidity Coverage Ratio, or LCR. Implemented after historical systemic failures, the LCR dictates that a bank's high-quality liquid assets, cash or easily sold securities, divided by its expected cash outflows over 30 days, must equal or exceed 100%. This creates the fundamental tension of asset liability management. Maximizing your net interest margin requires holding high-yield, risky, illiquid assets. That profit motive acts as a constant downward pressure, pushing high-quality liquid assets down toward the absolute floor of the 100% regulatory minimum. A bank's survival depends on flawlessly balancing aggressive profit extraction against the mathematical certainty of liquidity risk. To see how this balance is struck, we have to look at the legal reality of a bank deposit. When you place money in a checking account, it is not a bailment. The money ceases to be your property. It becomes an unsecured liability on the bank's balance sheet. On ANZ's Q3 2017 balance sheet, assets are $107 billion against $99 billion in liabilities. Isolating physical cash, vault cash, and central bank balances yields $3 billion. Contrasting this against $25 billion in demand deposits reveals an 11.81% cash reserve ratio. The remaining 88% of those depositor funds does not exist as accessible cash. It has been transformed into illiquid loans and advances to generate yield. The bank remains solvent solely due to a statistical assumption, the expectation that under normal economic conditions, only a tiny fraction of depositors will attempt to access their capital at the exact same time. Because of this extreme fractional leverage, any commercial bank is technically insolvent the moment a psychological panic breaks their statistical withdrawal models. The justification for carrying that immense liquidity risk lies in how the bank extracts yield from that deployed 88%. The primary revenue is interest income, generated by charging for mortgages, corporate loans, and credit lines. Set against this is the bank's primary cost, interest expense. This is the yield the bank must pay out to its depositors and creditors to secure its funding base. Stripping interest expense from gross interest income leaves a pool of net interest income. This feeds the bank's efficiency metrics, net interest margin, and return on assets, which measures how effectively every balance sheet dollar generates profit. The incentive structure is entirely aggressive. To maximize return on equity, a bank must eliminate idle cash and push as much capital as possible into long-term, high-yield lending. The relentless mandate to maximize margin pushes the balance sheet to the very edge of its liquidity buffer, turning even minor interest rate fluctuations into existential threats. How then does a finance leader boost returns
when chasing a higher net interest margin requires taking on a fatal level of liquidity risk. The solution is to diversify into non-interest income, revenue generated purely through service and administrative fees. A prime example involves the credit card market. There is a common misconception that Visa and MasterCard are issuing banks. They are not. They are purely payment networks that route data. When you look at the transaction path, the issuing bank sits at the very end of the line, extracting an interchange fee from the merchant for every swipe routed through those networks. The second major generator of fee income is wealth management. Here, banks extract a management expense ratio, or MER.
This is a percentage charged against the total assets under management to cover advisory and administrative costs. This revenue is structurally superior to interest income. It requires zero maturity transformation and locks up zero physical capital on the balance sheet. Non-interest income acts as a risk-free stabilizing ballast on the income statement. It quietly subsidizes the highly dangerous core business of fractional lending. Without that ballast, the fractional model is constantly exposed. If the statistical assumption of normal withdrawals fails, a psychological panic triggers a bank run. To prevent these runs from freezing the global economy, regulatory bodies instituted the Basel III liquidity coverage ratio. The mandate is absolute. Banks must maintain enough liquid assets on hand to survive exactly 30 calendar days of a severe simulated cash outflow. High-quality liquid assets are divided into Level 1 assets, cash and sovereign debt, and Level 2 assets, like less liquid corporate bonds. Because they carry market risk, regulators apply a liquidity haircut, forcing banks to devalue Level 2A assets by 15% in their survival calculations. This enforces a brutal operational reality. High-quality liquid assets are ultra-safe, but they yield almost zero return. Every dollar held in reserve is dead weight on the balance sheet, actively dragging down the bank's return on equity. The LCR is an intentional mathematical leash. It is designed by central banks to deliberately suppress a commercial bank's profitability in order to guarantee its survival during a crisis. When we combine these opposing forces, we get the master asset liability management framework used by modern finance leaders. The bank functions as a precarious optimization scale, continuously balancing yield against ruin. If the bank pursues aggressive lending, loan volume increases and drives up the net interest margin. But funding those long-term loans directly drains the HQLA reserves. The liquidity coverage ratio plummets, dropping dangerously close to the 100% regulatory floor. Conversely, if the bank injects non-interest income through Visa interchange fees and wealth management ratios, the profit side of the scale rises. Because these fees require no capital outlay, the liquidity side remains perfectly stable. This is the daily reality of a bank treasurer. They run continuous stress tests, model deposit behavior, and forecast credit losses to keep this mathematical scale from breaking. A commercial bank is not a static repository of wealth. It is a continuously optimized, highly leveraged risk transformer. When we zoom out from the balance sheet to the macroeconomic perspective, the stakes of this optimization become clear. The fractional reserve system is the undisputed engine of modern global economic expansion. It allocates capital to where it is needed, funding innovation, infrastructure, and housing. But that immense power is inherently fragile. The entire system relies strictly on borrowing short-term to lend long-term. Profitability in banking is never simply about finding good borrowers or charging high interest rates. Anyone can lend money. The ultimate balancing act is navigating the razor-thin margin between maximizing yield for your shareholders and hitting the strict, unforgiving floor of the liquidity coverage ratio. To master corporate finance is to understand that a bank's true product is not money. Its product is the precise mathematical management of systemic risk.